Has the auction market crashed? No, it hasn't. Has it rebalanced? Yes, it has. We've had a lot of change since the height of the pandemic in pricing and activity and buyer aggression or buyer willingness to jump into a deal. It has slowed down, but that is okay. We've got to rebalance into the market. And right now, we've got two different markets that are rebalancing, one being resale and one being new construction. And I'm going to tell you which one's feeling it most right now. Also going to look at mortgage rates, what we can see for the future in Q4 through the rest of the year and then into 2026. But in the meantime, if you're into food and wine, go check out the Food and Wine Festival down at Auditorium Shores this weekend. It is a blast. All right, but in order to understand what's happening in the market and why, we need to look at rates, right? Mortgages had a recent dip. They hit recent low at 6.17 last week, and that came ahead of the Fed's announcement of a 25 basis point cut on Fed rate. But remember, we're tracking with the bond market, not the Fed rate. Mortgages track what investor sentiment is as it relates to the 10-year Treasury bond. And after the Fed made their announcement, rates ticked back up. So it's not directly correlated, and I'm always harping on that, but it's true. So right now, the interest rate's at 6.23. That's up today on November 3rd. It's gone back up. If we look at estimates from some of the major banks and lenders, Fannie Mae says 6.4 at the end of the year, 6.3 from Wells Fargo. Mortgage Bankers Association says 6.4. On average, though, it looks like we're going to end up 2025 at about 6.5 for a mortgage rate. Now, 26, it could come down more, but because we have so little information right now about the labor market, we don't know what direction we need to go in terms of spurring the economy or slowing it down. We know that inflation's sticky, and if it continues to stick, we're not going to see rates go down because that's intended to encourage growth. So we're going to have to wait and see on that when we get more data from the government and we can start incorporating that back. We're going to know more, and it will be interesting to see if they use the data from the last month that we've been missing. If they just skip ahead, we're going to miss a big chunk, and it's still indeterminate on how they're going to do that. Okay, so now we know mortgage rates, they are where they are. We just have to wait to see what's going to happen, but they're generally between 6.2 and 6.5. And if you can get a rate in there, great, go buy. You can buy it down for even more. So you should be active if you're a buyer right now. In fact, I'm under contract on an investment home in Austin as we speak and have an inspection this afternoon. It's important to take advantage of this market. But are we crashed? No. We had peaks in 2022 of, let's see, 510 was the median price point. In 2020, it was 370,000. So that's a huge jump. And then last year, we were at 435. And this year to date, we're at 444 or 445, right around there for median price points. So what does that mean? It means we were here, we spiked to here, and now we're leveling out. Right now, we are stabilizing. Austin has largely gone through the correction, and it's going to start to tick back up in a meaningful way, especially if rates go down in 26. So if you're on the sidelines, don't wait. Get in there and go find the right home for you. So what is it that's making Austin such a buyer's market is inventory. In October, we had a 9% increase in new inventory on the market over the previous month, but we had a 2.3% reduction in under contract. So what does that mean? Well, less are going under contract because there's more choice, giving buyers more leverage. But the appreciation, as we just talked about, is going up. So we're seeing return of valuations of homes going up. And trust me, if interest rates go down on your 30-year fixed or others, you will see more competition. Inventory will go down and pricing will go up. It's important to keep all of that in mind. But David, we had 17% less closings in October. We crashed. We still didn't crash. The reason we had less closings in October is because we had less activity. It's seasonal, and we had a pop in August in under contracts, largely driven by new construction. We had a pop in closings in September, largely from those new construction contracts in August. And so it would be expected that we're going to have a slower closing from deals that went under contract in September. Now, new construction, they've got a lot of inventory they have to get off the market. They need to sell. Money's expensive, time is money. It's important for them to get these homes off their books, so they are creating huge incentives. And I talked about it last week. They have really low financing rates, right? So you can use their in-house lender and get a really good rate. They'll give you 20,000, 30,000, whatever, depending on the development, and flex cash to use towards closing costs. They are fire selling a lot of their inventory, and that is affecting the resale market's inventory by staying on the market longer. But prices are not plummeting. Sellers are becoming more aware of where they need to price their home, which is lower than where they had it listed. But that doesn't mean we've crashed. It simply means sellers are getting in line with what the market value of their home is today. And come spring, it's going to pop back up. So what's the lesson or the point of all of this? Well, it's to say, if you're a buyer, it is a great time to buy. You can refinance rates in the future if you want to get your monthly payment down. Higher inventory gives you more flexibility for negotiating. And don't cap your search at your highest budget price point. Go a little bit over because sellers are willing to come down. In fact, we have a lot of homes selling for 10%, 9% less than their original list price, which is not insignificant. It simply means they started high, but that the market value is about 10% lower, which is higher than it was last year. Sellers, it's important for you to price for today's market, not the future, not the latter, and not what you want to have. It's important to price for what you have. So pay attention to that. And investors, it is a great time to go buy a property. Go buy a property. You're not going to see this sort of opportunity again for at least a decade, if not more. So there we go. Resale market took their correction medicine in 23 and 24. 25 hasn't been gangbusters, but it's largely stabilized. And right now it's the builders' turns. They're taking a hit and they're trying to get their inventory off their hands and into yours. So there's opportunity there. Go have fun at the Austin Food and Wine Festival this weekend. It's a really good time, and you're going to have a ton of great food and good wines. All right. Reach out if you need anything or want any info specific to your home or an area you're interested in buying in or just want some market data. I'm a data nerd. Have a good one.